Canadian energy stocks are pricing in an Iran war premium that the underlying fiscal arithmetic does not fully support. Suncor posted record Q1 upstream production of 875,000 barrels per day and generated over $4 billion in adjusted funds from operations, numbers that, on their face, look like confirmation of the thesis. But the fiscal signal running beneath those results tells a different story about how durable this premium can be. Alberta draws more than 20% of its provincial revenues from non-renewable resource royalties, with WTI averaging around US 72 in Q1 before the Iran escalation fully repriced the forward curve. The province was already tracking a $6.4 billion deficit for FY 2025-26, roughly $1.2 billion wider than budget. The critical variable is the threshold. Unless WTI sustains above US 75, balancing the provincial budget becomes structurally impossible without spending cuts. The Iran war has pushed oil bid higher, and Suncor's free funds flow of $2.9 billion in a single quarter shows the upside when the price cooperates. But the IEA's warning that oil markets could enter a red zone by midsummer also signals that the supply disruption is not resolved, it is suspended. What institutional money did was buy the energy premium early. Canadian oil names saw foreign net positioning increase as the Hormuz closure scenario repriced the global supply curve, with the WCS-WTI spread already near fair value after TMX expansion removed the old Canadian oil discount. That spread compression added an estimated $13 billion in cumulative revenues since TMX opened, a one-time structural gain that the market has absorbed. The forward question is whether WTI can hold above the $75 fiscal threshold without the spread buffer that previously offset price weakness. Surge Energy's Q1 result, 23,893 BOEPD, above its own budget guidance of 23,000, shows that production is delivering. What it cannot guarantee is the price at which that production clears. The positioning that lifted Canadian energy names assumed a sustained oil shock. The residue is what happens to that positioning if US-Iran diplomacy produces even a partial Hormuz reopening signal, not a resolution, just a signal.
The same Iran war logic that lifted Canadian energy names has pushed the TSX Banks Index roughly 25 percentage points ahead of the S&P 500 over the past 12 months, and that gap is where the valuation problem hides. Rosenberg Research's own framing acknowledges the contradiction directly. Canadian banks are not a value trade at all, with PE multiples already re-rated to historical highs. The easy part of the move in their own assessment is behind us. Global allocators rotated into the Big Six not because Canadian bank fundamentals re-rated, domestic macro conditions offer no strong growth story, but because geopolitical fragmentation made Canada's hard asset exposure look like a diversification premium worth paying for. That is a capital flow logic, not an earnings logic, and capital flow logic reverses faster than earnings do. The specific risk is not that Canadian bank earnings disappoint Q2, BMO reports Me27, and the consensus is tracking 2.80 EPS, but that the diversification premium compresses as the Iran war premium itself oscillates. When foreign allocators bought Canadian banks as a geopolitical hedge against U.S. tech concentration, they were implicitly long Canada as safe haven. That position is currently unrewarded by dividend yield alone at current multiples. Institutional net positioning into TSX financials is interpreted from price and inflow action. Direct capital flow data is not available in today's news pool, but the 25-point outperformance against the S&P 500 in 12 months implies sustained foreign buying that exceeds what domestic fundamentals alone would generate. The re-rating was real. The question the re-rating leaves open is what the re-rating assumed about Canadian political risk, specifically whether investors in Canadian bank equities had priced any scenario in which the Canada as unified hard asset economy frame gets structurally contested.
Premier Danielle Smith's announcement of October 19th referendum asking Albertans whether to begin the legal process toward a binding separation vote is not priced in Canadian bank equities or energy infrastructure names. It does not need to succeed to move capital. It needs only to persist long enough for global allocators to reassess what Canada as hard asset haven actually means when the province producing 20% of federal energy royalties is asking whether it wants to remain in the country. The referendum question is deliberately structured to avoid triggering immediate legal separation. A binding result is constitutionally impossible under the current court ruling, and Smith said explicitly that 50% plus 1 would determine the outcome of the procedural vote only. But the signal it sends to infrastructure capital is more consequential than the legal mechanism. The $306 million Tenaris investment in Sault Ste. Marie, Canada's only seamless pipe manufacturer, backed by federal and Ontario governments to expand OCTG production, represents the kind of long-cycle capital commitment that requires a stable political geography. Alberta's participation in the federal energy framework becomes contingent on a referendum outcome. The pipeline and OCTG investment thesis that underpins Canadian energy capital expenditure changes character. It becomes a bet on constitutional resolution, not just on commodity price. Quebec's Parti Quebec has simultaneously promised a sovereignty referendum if it wins the fall provincial election. Two provincial independence vectors running concurrently, Alberta on October 19th, Quebec conditional on a PQ win, constitute a political risk frame that Canadian bank equities at historical PE highs have not absorbed is whether foreign bond or equity flow data shows any early repricing of Canadian sovereign and bank spreads relative to U.S. equivalents. That spread movement, not the poll numbers, is the first capital market signal that the Canada as geopolitical safe haven premium is being questioned rather than simply paid. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.